Let's welcome in Professor Jeremy Siegel of the Wharton School. It's good to see you again. I mean, that really is the question. You have been among the loudest people out there. Inflation, inflation, inflation. The Fed's going to have to be way more aggressive than the market thinks. Well, Gunlock now says inflation's peaking, and others have said it too. What do you think?
Well, I think, 8.5% year over year, that might be the peak, but I think there's going to be 6-7% year over year for a long time. By the way, I think Stephanie had it the top of your program in terms of there's a lot of very negative forces for inflation in terms of making inflation worse. I mean, we see oil above 100 again. I'm particularly worried natural gas, which is almost doubled. And I'm talking about February 23 gases when it's really used for heating is almost doubled, used for electricity also. If you take a look, as Stephanie mentioned, at the rental indexes and the home ownership indexes, they're only up 4 or 5% year ago. Well, we know home prices are up 15, 20%, and that's going to get into that index. So technically, will we see something higher than 8.5% year over year? Well, maybe not, but is it going to be that good if it stays at 6.5 to 7? Now, I do say that, the lower than expected core increase, and that's what the Fed looks at. So that certainly takes out 75 basis points, which I think James Bullard might have gone for at the May 4th meeting. So it's going to be 50, but I think we're going to see 6-7% for many months to come. And I think the Fed has to continue at least 50 basis points hikes for a number of meetings.
Well, honestly, I don't think anybody expected, Professor, 75 basis points in May.
No,
right? No one expected that. But the bottom line, it sounds like I hear from you, is that you are not changing your view on what the Fed has to do moving forward, and maybe more importantly, what it is going to do. In any way, you're not changing your view on that.
I still think that the Fed really has to get above 3%, 3.5% if it wants to slow the inflation, which I still think is moving through the system.
Now, tell me that, what does that mean for stocks then? What does it mean for stocks?
It is that same problem that we've talked about before. By the way, I still think earnings, as Stephanie did say, are going to be great this year. So that numerator is going to be great, but that denominator keeps on getting revved up that you discount it at. So what do we see? Exactly what we have seen, a very choppy market and a rotation, which I think will continue towards those stocks that have more near-term cash flows. I'm not ready to say that, technology is off to the races, although there's a lot of tech stocks that are, selling for very reasonable 19, 20 times earnings. Certainly they're fine, but anything more than that, I still think is going to be disadvantaged in this sort of market.